Welcome to the Deep Dive. We're your shortcut to getting smart on the latest earnings calls.
That's right.
Today, we are diving deep into Combank's second quarter 2025 earnings call. Our mission, as always, is to pull out the really important insights, the key financial nuggets. We want to give you a crystal clear understanding of how the company's doing, what management's thinking, and what's coming down the road.
Yeah, and it's interesting. Combank really managed to navigate what's, let's face it, still a pretty dynamic banking environment this quarter.
Absolutely.
Looking at just the high level numbers, they showed some significant momentum, profitability, capital management, pretty solid.
Okay, so starting with that snapshot then, what's the headline number that really jumps out for you from Q2?
For me, it's got to be the earnings per share. Combank reported $1.42 per share.
Oh.
And that's an almost 14% increase just over the prior quarter. I mean, in this industry, with all the pressures, that's a strong signal. It suggests maybe they found a growth lever that others might be missing.
14%, that's a big jump. And operationally, we saw something interesting with loans, didn't we? An inflection point.
Absolutely. Yeah, loans grew pretty consistently across most of their businesses. Average loans were up almost 1%.
Okay.
And period end loans, so looking at the end of the quarter, up approximately 3%. That tells you they're successfully generating new business, expanding their footprint.
Deposits, though, were a slightly different story, a modest decline.
Yeah, just over 1% down on average. But here's what caught my eye, maybe yours too.
The non-interest-bearing ones.
Exactly. Non-interest-bearing deposits held flat at 38% of the total. That's the fourth consecutive quarter.
Right. How are they managing that in today's rate environment? That's pretty key.
It's incredibly important. It really speaks to their stickier core deposits, which, helps keep their funding costs down. And speaking of costs and income, net interest income NII stayed stable. $575 million for the third quarter in a row.
Wow. So holding steady there despite the deposit dip.
Right. It tells us they're successfully offsetting those pressure points, likely with things like that loan volume we mentioned. It's a significant win.
And credit quality, always a big watch item for banks.
Still looking strong. Net charge-offs came in at 22 basis points. That's actually at the low end of what they consider their normal range.
Okay.
And non-performing loans, they actually declined. Lowest level in 4 quarters.
So even with broader economic, maybe, headwinds, their risk management seems effective.
It certainly looks that way based on these numbers. They seem to be managing, maybe even excelling at mitigating risk right now.
Good. And then quickly, the non-interest lines, income and expenses.
Both positive stories, actually. Non-interest income was up $20 million from the prior quarter.
Nice.
And non-interest expenses actually decreased by $23 million.
Decreased. What drove that?
Mostly lower litigation-related costs, and also salaries and benefits were down a bit.
Got it.
And all this happened while they kept their capital position really robust. Estimated CET1 ratio, that's the Common Equity Tier 1, came in at 11.94%.
Which is well above their target, isn't it?
Way above their 10% strategic target. And that's even after returning $193 million to shareholders. That was to dividends and notably increased share repurchases. They bought back $100 million in Q2.
Okay, $100 million. That signals some confidence. All right, let's dig a bit deeper then. You mentioned strong loan growth. Where was that coming from specifically?
It was pretty broad-based, really. New production, both for existing clients and bringing new ones in.
Okay.
Now, average loans in their equity fund services did dip slightly, but the period end trend there was actually up. They mentioned an improved outlook for private equity and venture capital activity feeding into that.
Right. Deal activity and fundraising picking up helps them.
Exactly. And overall, total commitments increased by $400 million. Environmental services and commercial real estate were up, offsetting some decreases in equity fund services commitments.
The yields ticked down slightly.
Yeah, just a touch. Average loan yields came down 3 basis points in the quarter.
Okay. Now, moving over to deposits, you said a modest decline overall. Which areas saw the biggest average decreases? Retail, corporate.
Yeah, the largest decreases in average deposits came from retail, corporate banking, and also technology and life sciences.
And the reason?
Management pointed mainly to seasonality, predictable patterns, and also customers just using their funds, working capital needs, project-related spending, that kind of thing.
Makes sense.
Deposit pricing did tick up 4 basis points on average, but that was pretty much what management expected, a bit of give back.
But their overall cost control on deposits is still good.
Yeah, they highlighted their cumulative beta, basically how much their deposit costs move compared to market rates is 67% since Q3 last year. They said that still outperformed the betas they saw when rates were rising, so costs haven't jumped as sharply as the market overall.
And they're investing there too.
Right. They specifically mentioned delivering 2 new real-time payment solutions. That's all about enhancing those sticky customer relationships, making the deposit franchise stronger long-term.
Gotcha. Okay, what about the securities portfolio? Saw a decline there.
Yeah, that was mainly due to paydowns and maturities. They're basically letting some bonds roll off rather than reinvesting right away.
So letting the portfolio shrink a bit naturally?
Exactly. And that actually helps offset some of the unrealized losses they were carrying. They expect AOCI, accumulated other comprehensive income, to improve over time as this continues.
And the plan isn't to reinvest heavily soon?
No, they stated pretty clearly no meaningful securities reinvestments until late 2025.
Okay.
And, going back to NII, even with those deposit dynamics, the higher loan volumes really helped offset things. That's how they kept NII stable.
Right, the $575 million number again.
Yeah. Though the net interest margin itself did compress slightly, just 2 basis points down.
But looking ahead, they see tailwinds.
They do. They anticipate structural tailwinds for future NII growth coming from their existing swap book and that securities portfolio runoff we just talked about. That's a positive sign for longer-term earnings power.
Okay, good. Let's circle back to credit quality. Stable overall, low charge-offs. But you mentioned management expects some normalization in criticized loans. What's going on there?
Yeah, they flagged that it seems largely concentrated in their middle market segment.
Okay.
They gave some specifics. 3 main credits were the primary drivers of the increase in criticized loans this quarter.
And the common theme.
All 3 apparently have a consumer component as the end customer. They're feeling the impact of, persistent inflation and those elevated interest rates.
What kind of industries?
Specifically, they mentioned luxury goods, the liquor industry, and also transportation freight.
Interesting mix. But despite that, their overall reserves are okay.
Seems so. Their
Okay.
coverage ratio, how much they've set aside for potential losses, held steady at 1.44%, unchanged from the prior quarter.
All right. Now, non-interest income up $20 million, expenses down $23 million. Can you break down those drivers a bit more?
Sure. On the income side, about $11 million of that $20 million increase came from capital markets. Things like syndication fees, derivative income, and a CVA benefit.
CVA, credit valuation adjustment.
Exactly. It's usually a mark-to-market thing on their derivatives. On the expense side, that $23 million decrease, as I mentioned, was largely lower litigation costs and lower salaries and benefits. Seasonal factors like lower incentive comp also played a role.
Okay.
There were a few other moving parts, too. A $3 million benefit from changes to the FDIC special assessment,
Right.
offset by $3 million increases elsewhere, like outside processing and advertising. Management also flagged a few favorable items that might not repeat, like those litigation benefits, some asset sale gains, and a state tax interest recovery.
Good to note those might be one-offs. So pulling this all together, what's the latest on their capital management strategy? Still conservative.
Very much so. They keep reiterating that conservative approach, that CET1 at nearly 12% gives them a lot of flexibility.
And they used some of that flexibility this quarter.
They did. They strategically redeemed some preferred stock.
Yeah.
The idea was to avoid a much higher sort of punitive coupon reset that was coming up.
Okay. Proactive move.
Right. Now, there were some costs associated with that redemption, so it caused a slight negative drag on EPS just for this quarter. But big picture, management says it's accretive to EPS below the net income line, meaning it helps profitability long term.
Makes sense.
And another boost to capital ratios movement in the forward interest rate curve actually helped their tangible common equity ratio improve by a significant 22 basis points.
Okay. And the buybacks.
They confirmed the plan is to repurchase another $100 million, approximately, of common stock in the third quarter, so continuing to return capital.
That's a clear signal.
Yeah.
Okay, let's pivot to the outlook. Full year 2025 guidance. What's the latest thinking on loans?
It's actually improved slightly. They're now projecting loans to be flat to down 1% for the full year. That's better than their previous guidance.
And the expectation is growth continues.
Yeah, they expect consistent growth in Q3 and Q4 across most businesses. The main exception is commercial real estate, which, remains challenging across the industry.
Understandable. What about deposits for the full year? Still expecting declines.
The headline number, average deposits down 2-3% for the year, is unchanged, but there's a key nuance here.
Okay.
They expect customer deposits, the core stuff, to be relatively flat. The overall decline is driven by a deliberate reduction in brokered CDs, which are more expensive and less sticky.
Oh, shifting the mix.
Exactly. They actually anticipate a moderate increase in overall deposits in Q3 and then a bigger jump in Q4. And they still see that non-interest-bearing mix staying strong in the upper 30% range.
Okay. NII outlook. Still that 5-7% growth range.
Still projecting 5-7% growth for the year, yes, but they flagged it might be towards the lower end of that range now.
By the caution.
They expect NII in Q3 to be slightly lower than Q2. That's partly due to that preferred stock redemption cost flowing through. And also some expected upward pressure on deposit pricing as they fund the loan growth they're seeing. They even mentioned Q3 deposit pay rates could potentially see double the increase we saw in Q2.
Okay, so a near-term dip before rising again.
That's the idea. They expect an upward trajectory again in Q4 and beyond, helped by those structural tailwinds from swaps and securities we talked about earlier.
Got it. Non-interest income and expenses for the full year. Any major changes to the outlook there?
Non-interest income growth is still pegged at 2% for the year. They see continued momentum in customer-related fees in the second half.
But Q3 might be flat?
Yeah, possibly relatively flat compared to Q2, mainly because Q2 had some unique benefits, like deferred compensation timing and that CVA gain.
Okay. And expenses?
Actually, the expense outlook improved. They now expect only 2% growth year over year, which is better than before.
That's good news on efficiency.
It is, though they do expect expenses to tick up in Q3 compared to Q2. That's partly because those favorable one-off items from Q2 won't repeat, plus normal seasonality, some inflation, and ongoing strategic investments in revenue-generating areas.
Understood. And wrapping up the guidance, credit and capital for the rest of 25.
Credit outlook remains stable. Net charge-offs expected in the lower end of their normal 20-40 basis point range.
Right.
Tax rate guidance also improves slightly, now expected around 22% for 2025, excluding any discrete items.
Okay.
And on capital, the message is consistency. Maintain CET1 well above that 10% target, keep capacity for share repurchases, but calibrate those based on loan trends, the economy, and, the regulatory landscape.
Right, always watching the regulators.
Yeah.
Okay, let's zoom out now. Broader investor context. M&A was a hot topic on the call, wasn't it? Management's view seems to be shifting.
Yeah, it was a noticeable shift in tone, I thought. They previously seemed to downplay the likelihood of much M&A activity.
Right.
Now they're more openly acknowledging that, M&A is likely to pick up across the industry.
And specifically for them, they mentioned the $100 billion asset threshold.
They did. They explicitly said that threshold, which often brings tougher regulation, is not a governor on how they think about potential M&A.
Interesting. So they're open to crossing it if the deal is right.
That's the implication. They still stressed organic growth is the primary focus, and they'll be patient acquirers. But the door seems more open than before. It definitely raises questions about their strategic flexibility in a consolidating market.
And that kind of leads into probably the most pointed part of the call. An analyst directly challenged management on Combank's long-term stock performance.
Yeah, that was quite direct. The analyst laid it out pretty bluntly.
What were the points?
Stock flat for 25 years. Down compared to 2018-19 levels. Significant underperformance versus banking indices like the BTX and the S&P 500 during the current CEO's tenure.
Ouch.
Didn't stop there. Highlighted the efficiency ratio, 68% year-to-date, and returns as being, quote, worst in class.
Wow, how does management even respond to that?
Well, it was definitely a moment. Their defense centered on this narrative of being in a rebuilding phase.
Rebuilding from what?
Post-COVID disruption, the end of quantitative easing, the regional bank crisis last year. They also mentioned specific actions like exiting certain business lines and rationalizing portfolios as part of this rebuild.
So the argument is we had to fix things first.
Essentially, yes. And now, they argue, they're leaning into the positives. The recent loan growth, the fee income trends, the strong deposit base, those structural NII tailwinds we discussed.
And pointing to future investments.
Exactly. Highlighting investments for longer-term growth, things like entering new markets, boosting payments capabilities, treasury management, wealth management.
So the message is the past was tough, but look at the foundation we're building now.
That's the gist. They finished by reiterating their commitment to, protecting the company, serving clients, managing risk, managing capital, and ultimately doing right by shareholders, acknowledging their fiduciary duty.
It's a clear tension, isn't it? That stark historical performance versus the rebuilding for growth narrative.
Absolutely. A key point for any investor to weigh.
What else did they say about the broader industry? Competition, uncertainty.
They consistently flagged the highly competitive environment. Price competition for both good loans and stable deposits is fierce.
No surprise there.
Right. They also briefly touched on uncertainty around potential trade policy changes and how that clouds economic forecasts. Standard stuff banks are watching.
Anything on new tech? Payments.
Yeah, there was some discussion around stablecoins and real-time payments. Combank seems to feel they're well positioned to be involved as these things evolve. They believe they have the talent and products to participate, but also acknowledged it's still early days to know exactly how it will all shake out.
Okay. Interesting dynamics.
Yeah.
Right, let's shift gears slightly. Time for our little thought experiment segment.
The not financial advice zone.
Precisely. This is purely for informational discussion, of course. Does not constitute financial advice. But given everything we've just unpacked, especially that tension between the long-term stock performance and the current rebuilding story, what's an outrageous but plausible trade idea related to Combank?
Okay, well, playing devil's advocate here, given those decades of, frankly, stagnant stock performance and the worst-in-class metrics highlighted by the analyst, despite management talking up the rebuilding phase and structural tailwinds, an outrageous idea might be to actually take a long position in Combank.
Long. Okay, that definitely fits the outrageous part. Betting on a turnaround after so long. What makes it plausible? What's the angle?
The plausible angle, I think, hinges almost entirely on that renewed M&A chatter in regional banking.
The consolidation theme.
Exactly. An analyst on the call even specifically mentioned a recent deal right in Combank's backyard in Texas. You combine that industry trend with management's own shift in tone about M&A.
Right. Not seeing the $100 billion threshold as a barrier.
Precisely. Add in their stated conservative capital position, those ongoing strategic investments they keep talking about. Suddenly, Combank could start to look like an attractive, maybe even digestible target for a larger bank. Someone looking for a well-capitalized, established franchise.
So the bet isn't necessarily on the organic turnaround succeeding quickly.
Not entirely. It's more a bet that the market might be overlooking the potential for an acquisition premium. That M&A could be the catalyst that finally unlocks shareholder value, even if the internal turnaround story takes longer to fully play out, or even doesn't meet expectations.
Interesting angle. Betting on the external factor rather than just the internal one.
It's definitely thinking outside the box given the history, but perhaps plausible in the current M&A environment.
Okay, a fascinating thought experiment. So let's wrap up our deep dive on Combank's Q2 call. Key takeaways. We saw notable EPS growth, pretty solid loan momentum picking up.
Stable NII, importantly, with those potential future tailwinds baked in. Strong capital management, clearly shown by the buybacks and preferred redemption.
Right. And an improving expense outlook. That focus on efficiency is definitely there.
And just to reiterate, as always, this deep dive is for informational purposes only. It does not constitute financial advice. Please do your own research.
Absolutely. So we'll leave you with this final provocative thought to mull over. Given Combank's very long history of, let's call it, stock price inertia, and considering the strategic investments and the market dynamics discussed on this call, will the company finally break free?
Yeah. What's going to be the ultimate driver of shareholder value here? Is it the continued organic growth story management is pushing? Or could it be an external catalyst, like the M&A potential we just discussed?
Something to watch. We certainly will be. Thanks for tuning in to The Deep Dive.